Australia may be avoiding the turbulence sweeping across Europe, but the resource-rich country could be in danger of missing out on the capital its economy vitally needs by not cashing in on its resources boom. Joining me now on the phone is Markus Grimm from Allied Strategic Resources. Markus, ANZ Bank Chief Executive Mike Smith has said that Australia needs to invest $1.8 trillion over the next 20 years in order to capitalise on the country's resources boom. Australia is already set to overtake Qatar as the world's biggest liquefied natural gas producer by 2020. But will concerns over capital constraint limit expansion across the resources industry?
I think he hits the most important point, and that's not just for resources. I think we're going to see huge capital constraints globally. Ironically, you see government bond yields at record lows. In England, they're at the lowest point since the Bank of England, began recording interest rates. On the other hand, I think the private sector, and particularly mining, is looking at the biggest capital constraints ever. One of that is, of course, that the risk premium is going to go up sharply. And the second is, that eventually resources demand will be very, very big. And really the question is, where is all that money coming from?
With costs of doing business in Australia already rising, though, are there concerns that they could be pricing themselves out of the boom?
Well, indeed, of course, costs are very, very important. We just talk about cost of capital. That definitely is going to go up or has been going up tremendously for the miners, implied or actual. I think domestically, Australian costs are under control, but the financing costs, I think, are going to go up. So ultimately, of course, it's the market which will bring, both sides into equilibrium, and it will be a painful, adjustment process. And to close off on this, I think one really has to look at the specific resources. One cannot just, cut across the board. And within resources, you have to clearly look at which company you're investing in. The cost game is absolutely crucial because in any industry, you can tell usually the lowest one-third of producers, they will survive in any circumstance. The medium tier, so-so, and I think the most expensive, producers, the upper one-third, they're probably going to be, not going to make it.
A stock market drop of 5.6% last week disappointed equities investors, putting the Australian stock market on course for its worst month since May last year, with resources stocks bearing the brunt of this drop. While there's been some improvement on figures this week, Eurozone pressures and concerns over Chinese growth stimulus has caused some investors to predict that resources stocks could bottom out. Is this a possibility?
I think, the market, of course, has thrown out all resources stocks from, the very best BHP. We are looking, at mining companies in a development stage. They have been down 80% in some cases, some rightfully, as I said before, and others, it really makes no sense because they're now at price-earnings ratios of sometimes below 1. Again, one really has to start looking at individual companies. But will the market go down further? It's quite likely because I just attended the 2-day Wharton conference in Milan last week, and we met even the central bank governor of Italy, and not to misinterpret what he, has said, but it's very clear politically Europe is a long way off from even, marginally solving, its core problems, which is definitely one of the major reasons why global risk premiums continue to go up. That's definitely not good for equities.
Australia has been quick to feed powerhouses such as China and India with vital commodities, subsequently driving up the value of its currency. With the Australian dollar hitting new lows against the greenback, how true do you think claims are that the Aussie dollar has become overvalued? And where do you see this heading?
Can look at few things. Of course, Australia has been running current account deficit. That's definitely a problem for any currency. On the other hand, its currency was driven by resources demand, huge resources demand. If you look at the forward ratio, of course, with interest rates in Australia still higher and highest in the OECD countries versus the US, of course, that implies, a weaker currency. That is quite clear.
Markus, thank you. That's all we've got time for right now, but do stay tuned to Dukascopy TV for more exclusive interviews. Goodbye for now.